Hello, D7 here with FreeTradingVideos.com. Let's take a look at the markets. Consider this here the weekend edition. I'm going to delve in a little deeper. The S&P. Now check this out. We do have a bullish Harami reversal pattern in the making. 20-day moving average acting as resistance. But this is a nice strong move. Right at the end of the day, we had a rally. Check out a 30-minute chart or even a 5-minute chart or a 15-minute chart at the close this week. Nice and strong. Now, this is what we're looking for. Bullish Haramis, that's a bullish formation. We should, if we go higher, I'd want to see a close above today, and preferably a close above the 20-day moving average. If so, we could have an inverted head and shoulders. How long will it last? I don't think all that long. But nonetheless, that's what we'll have. If we come crashing down here, again, we're going to be hitting 850. We'll probably hang up there for a minute and just crash right down to 800 area. Be looking for that. On the MACD, we're just barely below the zero line still. You can see that number right there. For it to go bullish, we need to get above that, and we should see a nice run to the upside. Now watch this. I'm gonna plan a couple trend lines here. This swing to this swing. And if we go higher, I'll be able to draw this trend line. So I'm just guessing if we do go higher. Now take a look at this. What formation do we have with this line and this line? It's called a rising wedge. Even if we do go higher, we're going to, hit our head right there. We should come on down. A rising wedge is a bearish formation. So the only way we're going to truly go bullish is if we come up and we break over this resistance line. And then we're going to be dealing with the 50-day moving average coming right down. So there's nothing saying, listen, the markets, we were up today with a horrible, the job numbers came out. We're at a 14-year high on unemployment right now. The economy, I think we are somewhere around 250,000 jobs lost just in October. I think 240,000 was the exact number. And Obama is trying to get in a stimulus package by January. And GM is saying that it's going to run out of cash in early 2009. Interesting. But nonetheless, we are up 200, almost 50 points today in the markets. Isn't that wild? So let's go a little further here, and we're going to check out the weekly. But I'm going to pull up the weekly spiders. This is the S&P ETF on that. Here's the weekly. We come crashing down. We have what looks to be a low base formation. Low base is very bearish. A low base formation is just bearish any way you look at it. And pay special attention to that. Let's look at a monthly. The monthly, we have a number of legs coming down. We had 5 legs coming in, 2 up, 2 down, 1 up, and then we have 1, 2, 3 down. Usually in a downtrend you have 5 to 6. So I'm looking for more days to the downside. But this is called a morning star reversal pattern, a morning star. If we go higher than this, if we can get over 10,000 on the S&P, expect a 2 to 3 month jump in the markets, and so we could have a nice little pop here. But if we continue to base sideways in this month, it'd be a low base formation, especially if next month we get a little smaller candlestick right here. That'd be like it would be like a bearish pennant type formation, highly explosive to the bear side. So by no means are we out of the woods. And listen, trading can be very dangerous. I want to make that very clear. You have to protect yourself and be well educated in the markets. Don't get suckered in by the talking head saying this is the bottom. It's asinine to say that when you have a monthly chart bleeding to death like we see here. Who says it's the bottom? Show me something that says it's the bottom. Let's go back to the weekly. Who says this is a bottom? All this is a low base formation. Go to chartschool.com there at Free Trading Videos and you'll see that for yourself. that this is a bearish formation on the weekly. Just be really careful with that. If you take a look at the Dow, let's look at the daily on the Dow. Check this out. We pop up, we might find support. I mean, this looks just like the S&P. It needs to get over the 20-day moving average, and it's going to smack its head at 9,500 if, in fact, it does that. If it doesn't, it's going to hit down to 8,000 really fast, and it should find some support there at 8,000. And let's also go to the NASDAQ. Here's the NASDAQ, nice falling wedge. We pop up, we do a pullback. We have a nice bullish Harami formation. Still needs to get over the 20-day moving average. If it doesn't, boom, 1,500 before you know it. That's its next stop. And the Russells. Remember, the Russells will be the first ones out of the gates in a true bull market. It looks like, much like the S&P and Dow, we have an inverted head and shoulder type formation if, in fact, we get an upper leg here. But here, much like the S&P, let me draw a couple trend lines for you. We have this line and this one. If we do, in fact, go up, we have kind of a triangle or a rising wedge formation. So, you know, you could even probably draw this one and this one. Nice symmetrical triangle, those two. So don't do anything in this area. You make your decision when you break out of this or down below it. So there you have it. There's the weekend edition. Happy trading to everybody. Be safe out there in the markets. Always trade with a stop loss. And remember, capital preservation is key. We'll see you at freetradingvideos.com.